the breakout from the range from 2018 or 2019 to until it broke out earlier this year is not a blip. It's the beginning of a powerful advance. It'll have its ups and downs, but it's not a fluke. It's going to, I think all the things we talked about, and probably some we haven't even thought about or even mentioned, are there to generate interest, flows into the metal, and flows ultimately into the mining stocks.
How do you explain the lack of interest and negative sentiment in gold? Is it strictly a function of the fact that tech and AI is casting a historic shadow over literally everything else in the investment space? Is it something else? How do you explain this lack of interest and sentiment?
No, I think it comes down to people are, they're long equities. They're long the idea that we're going to sail through. There'll be no economic downturn. Earnings will be fine. They'll be higher in 2025 than 2024. That is the fantasy that people and their advisors are living in, that needs to be disrupted before you see any kind of motion. And you'll see it. I'll see it in ETF flows for the metal and for the mining stocks.
So, John, like we've been discussing, sentiment in gold is negative. Investors are underpositioned, macroeconomic risks, they're largely unrecognized. Multiple catalysts stand ready to activate a renewal of interest in gold and related mining stocks. And aside from the few that we've mentioned, a secular bear market in bonds, an unexpected recession, potentially adverse consequences of de-dollarization, the stock market dropping, the list can include all things geopolitical, overvaluation, just keep going, the political scene.
Right. That's a pretty good list, but it's probably incomplete.
Yeah. So in light of all this, in your analysis, is gold literally setting up for a multi-year advance that might end up looking more like the 1970s and early 2000s?
Yeah, no, yes, you're sort of asking about the time frame. This rally in 2024, the breakout from the range from 2018 or 2019 to until it broke out earlier this year, is not a blip. It's the beginning of a powerful advance. It'll have its ups and downs, but it's not a fluke. It's going to, I think all the things we talked about, and probably some we haven't even thought about or even mentioned, are there to generate interest, flows into the metal, and flows ultimately into the mining stocks.
Okay, so more than 70% of portfolio advisors own less than 1% of gold. We kind of danced around this earlier, and gold-related assets in their portfolio. This is really historically low, and despite gold's big move, they're still not on board. Other than, will it take a dramatic stock market decline, that 30 to 50% decline, or is there something else that can get them moving towards the stability of gold, towards gold and possibly even silver? Or is it only going to be a 30 to 50% stock market drop?
No, it doesn't have to be a catastrophic kind of decline in the market. I think just it's more, it could be. I hope it's not. That would be a sell everything kind of scenario like we had in the global financial crisis. Very, very painful for everybody. And I think even gold and gold mining stocks would probably be hurt in that kind of, but what I'm thinking that could also be the case would be just be and I actually lived through this in the 1970s, just a grind lower. So if you look at the decade of the 1970s, and there are a lot of, that's sort of an analog, but there are a lot of things that are different. But you basically had a decade where stocks went nowhere. Yeah, there were rallies, there were pullbacks, but from 1970 to 1980, stocks went nowhere, and it was a grind. It was the march to Corregidor, and dispiriting. And by the end of the 70s, you would be afraid to admit you were an investor in the stock market. You just wouldn't go to a cocktail party and say, "Hey, have you heard my latest investment idea?" No, you talk about other things. That was a long process to change the psychology from stocks are a great place to be to stocks are, well, they're not such a great place to be. We're so far from that. And there are cycles in psychology, and they arise from not a day or two of bad experience. They are generational, and so you need. And again, I don't want to sound so. I am obviously negative on stocks and valuations. But there'll be a time to be bullish on stocks. But right now, I think everybody's on the other side of the boat, and some of them have to kind of come back to earth and say, "Gee, valuations are crazy. Business outlook is questionable. I need safety, and how do I profit from that?" And that. We're so far from that. And again, I went through this in the 70s. People are people. Human nature doesn't change. And I think what we could see over the next several years is a shift in psychology that would take the boil off of the excitement for expensive stocks. And I think the big beneficiary of that will be the precious metals complex.
So speaking of psychology, there's many precious metals investors who they're really nervous about a potential recession, bear market, etc. And so they're very leery about holding mining shares during that and wanting to wait until after that's completed. So, or the worst has been done so that they can get to the other side. And of course, timing the market is virtually impossible. So my question is are you recommending to have a seat at the table to own these shares? Or are you recommending or prefer to wait until after a recession has done its worst?
Well, let me make a couple of comments about the fundamental outlook for mining stocks. And market timing is very, very hard. And I've always been a long-term investor. So yeah, sometimes you buy at the wrong price and you ride something down a little bit. And so what's important to keep in mind is the fundamental picture, which in the case of gold mining stocks is completely misunderstood. First, most people think, well, gee, this rise in the gold price is a blip. And I would say, no, it's not. It's going to last for a couple of years, 3, 4, 5 years. Secondly, the profitability of gold miners is rising faster than the gold price. Why is that? And that's because in a recession, commodity prices are declining. So the cost of producing metals is declining. So the price is going up. The cost of producing it is going down. So earnings are going up. The average gold price rose in Q1 over all of 2023. In Q2, it rose over the first quarter of 2024. And for the third quarter, we're on track for the average gold price to be higher than the second quarter. So, don't be overly concerned about the day-to-day fluctuations that you see on Bloomberg or CNBC in the gold price. Pay attention to the average price, which you can get on Bloomberg, year to date, quarter by quarter. And the second thing is, I would urge anybody who's interested to look at the ratio of the gold price to the CRB, which is a proxy for commodity prices, and it's on a rising trend. A rising trend in that ratio means that gold is outperforming commodities in general, and that means margins are expanding. Again, to beat a dead horse, prices up, costs down, profits expanding. Even in a flat gold price environment, profits can get better. So we could be in a period where corporate earnings in general for the average S&P company are challenged, but in the gold space, there's a case to be made, which I hope I've just made, that profits will actually be growing. And I think that alone ought to attract some interest.
That was well said. So, John, government bonds, they're losing status as the unquestioned go-to safe asset amongst a group of people, not everybody, but a group of people. It looks like bonds have begun a secular bear market several years ago. Gold's breakout against the iShares 20-plus year Treasury bond ETF, it depicts slippage in favor of gold since 2020. Is this global trend to move to gold for settlement and reserves instead of U.S. bonds, which you were talking about in your earlier commentary over the BRICS, is it more than a blip on the screen and rather a long-term trend with long-term consequences?
Yeah, I think we still face a reassessment of bonds as a safe asset, not as a trade. I think bonds are a trade because of the recession that I expect to take place. And so there will be the usual flight to safety into bonds. And, the more aggressive you want to be, the longer out on the yield curve you go. So that's kind of a tactical kind of view. The reason I think bonds are no longer a safe asset should be pretty obvious, and that is that the finances of all democracies are just horrible. And bonds are basically the issuance of the United States, of European countries, Japan, who cannot get their fiscal house in order. And therefore, at the end of the day, the basis of a bond is going to be inflated away. People think, well, gee, gold is, I probably haven't said this yet, but, gold has outperformed bonds and stocks since 2000. Why 2000? That was the dawn of this radical monetary policy, QE and so forth, ultra low interest rates. So gold has gone from, roughly $300 or so an ounce to $2,500 an ounce. And that is a measure of the loss of value of the purchasing power. And so, people think, well, my house is worth so much more. Well, try to replace that if you sell it and try to move. Everything that's tangible has gone up. Some things more liquid than others. Obviously, real estate's the least liquid. But just about anything you can name costs more today than it did 25 years ago. That shouldn't be a surprise. But again, it is the way this gets back to the question on bonds. Principal value is always par, but that par value loses purchasing power over time. And that's why bonds on a secular basis cannot be considered a safe asset in a world of reckless fiscal and monetary policy.
The AI revolution and the data center explosion, alongside the growth of EVs, solar panels, advanced military weaponry, and the electrification of everything, That's raised silver demand annually, causing supply deficits for the last 4 to 5 years. While supply, it's remained relatively flat. What do you see on the horizon for silver supply and demand dynamics and silver prices?
Well, I think you said it perfectly that the supply is fixed for now, at these prices, and demand, all the uses, EVs and solar panels and, all of, I'm sure technology comes in, they're expanding. But to me, the argument for silver, I think all of those things are true, but to me, the argument for silver is that it's a monetary metal on steroids. So all of the things that we talked about for gold are true for silver in spades because it's such a much smaller market. And that's why, again, we haven't talked about silver or the silver price, but again, I think there are lots of surprises on the upside there as well.
As gold continues to rise, John, in price and gains more attention and people start talking about it with their neighbors, their friends, their family, do you think others are going to look at that and say, oh, I need to get gold, and then they see, oh, it's 2,500, it's 3,000, it's 3,500, and they say, well, that's too expensive, but look at silver, it's 35, $40. I can go get a whole bunch of silver.
Right. Yeah, I think that's right. That's part of the appeal of silver is its per ounce price is more retail friendly. I mean, it's not to dismiss it. It's just more easily. I mean, the everyday investor can probably get their arms around $30 an ounce even more easily than $2,500 an ounce. I don't think it really matters. I mean, it's a concept that just it's sort of the mentality, an investment mentality. But again, I think because silver is in effect a smaller cap version of gold, its percentage upside could be greater than that of gold. Sure, I would have silver. I mean, I prefer gold, but I think at some point along this, and we're nowhere near this movement into precious metals by investors in our part of the world, silver's got percentage-wise probably more upside than I can see for gold.
So the gold mining equities seem to be so deeply undervalued, and they're offering really attractive leverage to any further upside that gold can be looking at. And here we are possibly facing a great mining bull run like the 70s or 2000s, yet so many people are absent.
Well, that's exactly why there's upside, because nobody's there. It won't take a big flow into mining stocks to, we've talked about the fundamentals. They're cheap on almost any metric in terms of enterprise value to EBITDA, earnings, dividend yields. I mean, they compare favorably to the S&P as of now, and they have a good outlook because metals prices are going up and costs are stabilizing or going down. So the fact that nobody is there makes me think that small flows can have a huge impact on percentage increases in share prices. That the entire space is about the size of Home Depot. It's ridiculous. It's tiny, and if we just went to 1% or 2% of the S&P, which are like a fraction of that right now, gold stocks could easily double or triple, given the fundamentals I've outlined.
Yeah. So regardless of anything that happens with the broader market, whether it goes down or stagnates, are you expecting sell-side analysts and strategists to begin to raise earning estimates for the companies as well as the metals at some point here soon?
Yeah, no, you're starting to see that. I mean, nobody listens to them, but they are raising their estimates. And they're still using these models that have a lower gold price a couple of years out, but still they're raising their estimates. They're raising their expected gold price. It's just typical of any investment idea that people are behind the curve and then they chase it, raise their targets, all that. But we're at the really very beginning of that process. And again, I've been doing gold for, gosh, I think 25 years now. And I think we're, in terms of sentiment, about where we were in the late 90s, where it was just basically disregarded. Again, this is in the investment world now. And in the late 90s, we had central banks selling it. They're idiotic bureaucrats selling it because they wanted to put their reserves into higher yielding paper. Well, that was a stupid idea. But you know, at least the central bankers have figured out, well, gee, it's a better place to be, at least diversification away from the dollar. So that's changed a little bit. But investors just don't care. And I think they will care. And I think when they start to care, we'll see much higher prices, both in the metal and the stocks.
John, I have a question on uranium for you. The uranium case seems to strengthen daily as more countries move to add more nuclear power. And the largest producer, Kazatomprom, they continually to miss production estimates and lower guidance for the next year. Yet the price of uranium, it's slumped some in recent months. The miners have slumped badly. What's your analysis of the uranium and uranium miners space?
Well, as you may know, Sprott has quite a bit to say about uranium, and that's not my area of expertise, but I will agree that the investment case is very strong. Maybe it's been a little bit overplayed for a while. It's been a hot space. And so maybe we're having I guess what analysts call a healthy pullback. But certainly the longer term case for uranium, the need for it, all of that is very, very constructive. I would urge anyone who's interested in uranium to look at the Sprott website.
So this has been a wonderful conversation. Before we wrap up here, and I ask John our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with John as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's now time for our Golden Nugget segment. John, let's discuss portfolio positioning. Based on all that we've discussed today and with your experience and worldview as a backdrop, how are you positioning for the next 12 months? What assets do you like and what assets do you absolutely want to stay away from?
Well, in terms of the stocks, Gary, we pay a lot of attention to jurisdictional risk. And so many countries have let the rule of law slip. And so these mines are there for 30, 40 years. And if the laws change over time, the economics change, and almost always in a less favorable way. So we spend a huge amount of time analyzing jurisdictional risk. And what that sort of, to sum that up, the world has shrunk dramatically in the last 25 years. What used to be safe is no longer safe. And what that means is that countries that are good neighborhoods to be a gold miner are fewer and fewer, and therefore the equities in those that are weighted towards those good neighborhoods are more and more scarce. Anyway, so as to our positioning, we are heavily weighted towards good neighborhoods. We we tend to be weighted more towards middle and smaller cap names because there are developments that we analyze as a team in terms of new mine construction, M&A, discoveries, that sort of thing, which don't move the needle for the large cap companies, but move the needle for mid and smaller cap companies. So we're heavily weighted to mid and smaller cap, but we still own large cap names like Newmont and Agnico Eagle.
One question I didn't ask you earlier that I do want to ask you is about M&A. Are you expecting a sizable M&A activity cycle this time around?
Yes, yeah, we're starting to see it. We've had several takeouts this year alone, and I think we'll see more.
Well, John, thank you for coming on to the Metals and Miners podcast, for being so generous with your time, your analysis, and ideas. It's really been wonderful to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they can learn more about your work and how they can connect with you?
Sure, and thank you. The Sprott website, Sprott Inc., it'll come up as soon as you Google it, has a wealth of information on precious metals, on transition metals, energy transition metals, uranium, you name it. So I would say that's a good place to start, and then from there you can navigate your way towards what we do in the managed equity space, or what we do in terms of closed-end funds where you can own physical metal in a safe and secure way, and a lot of educational information in addition to that. So Sprott Inc. is the way to go.
So Sprott is literally the preeminent destination for the precious metals. If you are not following Sprott, you need to follow Sprott. You need to get involved with Sprott. Like I said, they are literally the preeminent in the space. John, I look forward to having you back on. Thank you for being here with us, and everybody else, thank you for watching.
Thanks so much.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.